Hello and welcome. So in this lecture video, we're going to continue our discussion of accounting for purchasing merchandise inventory. So we ended the last lecture video by showing the journal entry for a purchase discount, for paying the accounts payable and taking a purchase discount. And what we said was we debit accounts payable because the liability is going down. We don't owe them that money anymore. So we debit the accounts payable. That's the way to decrease the liability. We credit cash for 98% of the $1,200 because we took a 2% discount. And then we credit merchandise inventory for the 2% discount. Now again, why do we credit merchandise inventory? That doesn't mean that merchandise inventory is we have less merchandise inventory. Because remember, merchandise inventory is an asset, and by crediting the asset, that asset is going down. But what we're saying is that the cost basis of merchandise inventory has decreased. So the cost basis of merchandise inventory, which is what's up on the balance sheet for the current asset, is equal to the cost of the merchandise that you bought, plus any normal and reasonable expenditures to get it ready for sale, minus any purchase discounts, purchase returns, or purchase allowances, which is what we're going to talk about next. So I'm going to say it again. The cost basis for merchandise inventory is equal to what you bought it for, plus any normal and reasonable expenditures to get it ready for sale, minus your purchase discounts, your purchase allowances, and your purchase returns. Okay? So the cost basis has decreased. How do I decrease an asset? With a credit. So that's our journal entry. So then when we look at our T accounts over here for merchandise inventory, remember, we bought it for $1,200. And then what we had over here is we're crediting it right there for 24. So that means the balance in merchandise inventory. Okay? And then what's our accounts payable? AP, accounts payable. Remember when we when we bought it, we credited accounts payable, and then up here, we debited accounts payable. So the balance in AP, accounts payable, is now 0. All right? So now let's look at purchase returns and allowances. We'll talk about purchase returns first. So this is when we bought merchandise inventory from our supplier, and we said, well, it's no good, or we don't need it anymore, whatever. We're going to return it. That's a purchase return. So we are returning it. Okay? So let's look at that example. So Z-Mart purchases $1,000 of merchandise on June 1st with terms 210 and 60. What does this mean? You take a 2% discount if you pay within 10 days. This is the discount period. Otherwise, the full amount is due within 60 days. 2 days later, Z-Mart returns. We're Z-Mart. We return $100 of goods before paying the invoice. When Z-Mart later pays on June 11th, it takes a 2% on the remaining $900 balance. Oh, wow. There's a lot going on here. Okay. So we're going to attack this problem. We're going to do a journal entry on June 1st to recognize that we purchased it. We're going to do a journal entry on June 3rd, 2 days later, to recognize that we returned the merchandise. And then we're going to do our journal entry on June 10th, which is 10 days after. This is at the end of the discount period, to recognize that we're going to pay the remaining $900. And we'll talk about how we got this, okay? So I'm going to flip the page over. And we'll come over here and we'll say on 6/1, when we purchase it, we debit merchandise inventory for the $1,000, and then we bought it on credit, so we credit accounts payable. Okay? Then on 6/3, we're returning some merchandise inventory. All right? Returning merchandise inventory, $100 worth of merchandise inventory. So that means the cost basis of our merchandise inventory has gone down. The cost basis of our merchandise inventory has gone down. How do I reduce the cost basis of merchandise inventory in terms of debits and credits? Well, I will credit it because merchandise inventory is an asset. The cost basis of that asset is decreasing. I recognize that with a credit. What do I debit? Well, if I returned $100 worth, do I still owe $1,000? No. I owe $900, $1,000, $100 less. So I'm going to decrease my liability by $100. my accounts payable by $100. How do I decrease the liability in terms of debits and credits? Well, think back to the accounting equation. I debit the liability. So I'm going to debit accounts payable, AP, for $100. And then I will credit MI, merchandise inventory, which is the cost basis, for $100. Okay? So the cost basis of my merchandise inventory has decreased by $100. Now, if I look at my accounts payable T account, we initially bought it for $1,000 right over there. So that's that $1,000 credit. And then I debit accounts payable, $100. Now, what's my outstanding balance in accounts payable? $1,000 minus $100, $900 credit. Okay? That's how much I owe on my accounts payable. Now on 6/11, I come over here and I'm going to pay the remaining $900 of my accounts payable. And then since I'm on day 10 of the discount period, which is the last day of the discount period, I can take that discount. And what's the discount? It's 2%, because it says so. 210, 2% paid within 10 days. Take a 2% discount. All right. Now, I can't take 2% off of $1,000. Suppliers aren't that generous. I can only take 2% off of the remaining accounts payable. Okay. So to pay off our remaining accounts payable and to take that 2% discount, I'm going to debit my accounts payable for $900. I will credit cash for 98% of that $900 outstanding accounts payable, which comes out to $882. And then I will credit merchandise inventory, MI, because I'm being lazy, merchandise inventory for the 2%, which is $18. And that completes my journal entry. Okay? That completes my journal entry. All right. So now let's look at the next page where we talk about purchase allowances. Okay? So with the purchase allowance, there's a difference between a purchase return and a purchase allowance. Okay? And there is a slightly different, well, it's a pretty similar journal entry, although we're just not going to go through the paying it off. Okay? What's the difference between a purchase return and a purchase allowance? Well, a purchase return is when we bought the merchandise inventory from our supplier and then we give it back to them. We say it's no good. A purchase allowance is when we bought the merchandise inventory and let's say we bought the hydro flask and it has a little bit of a scratch in it. Okay. Do we want to return it? Or maybe we'll keep it and try to resell it to our customers. But we tell our supplier, hey, look, this merchandise, this thermo flask has a small scratch in it. We want some money back. We want some money off our bill. That's a purchase allowance. So we think we can still resell it, so we don't want to return it, but we want some money off our bill. That's a purchase allowance, okay? So we look over here. Let me just, so that's what I'm saying up here. Buyers keep the defective, but then the seller grants an allowance, so it takes money off our bill. Now, when the buyer returns that merchandise or takes the allowance, we're the buyer, we issue a debit memorandum. That's a fancy word. We issue a debit memorandum. What does that mean? A debit memo. It means, hey, we're going to debit or reduce our accounts payable that we owe you. So we're going to debit or reduce our accounts payable. That's why it's a debit memo. Okay? And to inform the person that we bought it from, the supplier, that we made a debit to that seller's accounts payable in our records. That's what that's telling you. Okay? So on November 15th, 11/15, we issue a debit memo saying, you know what, you sold us some defective merchandise. We don't want to return it, but we want some money off our bill. Okay? For $300. So I'm going to debit AP, my accounts payable, for $300. And then similar to what I did with my purchase return, I will then credit merchandise inventory, which is the cost basis. Remember, this is the cost. I'm reducing the cost basis of merchandise inventory. Because how do we get to the cost basis for merchandise inventory? It's what you bought it for, plus any normal and reasonable expenditures to get it ready for sale, minus purchase discounts, purchase returns, and purchase allowances. So I'm decreasing the cost basis for merchandise inventory. Okay? I'm decreasing it right there. So let's look at our transportation costs and then ownership transfer, right? So what we say over here, buyers and sellers have to agree upon who's responsible for paying any shipping costs, freight costs, and who bears the risk of loss during transit for merchandise transactions. Okay? Essentially, when does the buyer take ownership from the seller? Okay? So that's what we have to decide. And there's two different options. Okay? The point of transfer is the free on board FOB. That determines who pays the transportation costs and also insurance, who bears the risk during transit. Okay? So we have two options. We have FOB shipping point and FOB destination. Okay? So FOB shipping point is when the buyer accepts ownership when the goods depart the seller's place of business. So as soon as it leaves the seller's place of business, we accept ownership. Okay? So the buyer is going to be responsible in that case for paying the shipping costs and also insurance and bearing the risk of damage while those goods are in transit. Okay? The goods are then part of the buyer's inventory when they are in transit, when they leave the seller's place of business, because we have the seller has transferred ownership to us as soon as it leaves the seller's place of business. So while it's in transit to get to us, we're the buyer, we own it. We accept responsibility for it, and we're paying the shipping. That's FOB shipping point. Okay? FOB destination, on the other hand, the ownership of goods transfers to the buyer when it arrives at our place of business. That means the seller is responsible for paying those shipping charges and the insurance and bears the risk for any damage or loss. Okay? The seller does not record revenue from this sale until the goods arrive, because the ownership transfers when they get to us, the buyer. The ownership of the goods transfers to the buyer when they arrive at our place of business. Okay? So with this example down here, we have this little diagram, and it's saying FOB shipping point, FOB destination. When does the owner transfer the goods, and who pays the transportation cost? This diagram kind of summarizes what I just said. With FOB shipping point, the carrier pays, right? And then the ownership transfers when the goods are passed to the carrier, and then the buyer pays. I'm sorry, I was looking at the wrong thing. With FOB destination, the ownership transfers when the goods are passed to the buyer, and then the seller pays. So let me repeat that again. With FOB shipping point, the ownership transfers when the goods are passed to the carrier. The transportation costs are paid by the buyer. With FOB destination, the ownership transfers when goods are passed to the buyer, and the transportation costs are paid by the seller. Okay? So if you look over here at this example, Zmart purchased merchandise on terms of FOB shipping point. Okay? That means the buyer accepts ownership when the goods depart, and it also means that Zmart, because we're the purchaser, we're the buyer, we are going to pay those shipping costs. We're going to pay those shipping costs. Okay? So when we think about that journal entry, we're going to record this journal entry, the transportation costs, because we have to pay those transportation costs. We will debit merchandise inventory for $75, which is the shipping charge, and then we will credit cash, because we're paying for the shipping, for $75. Now, does this mean that we have more merchandise inventory on hand? Not really, because we're just paying for the shipping charge and debiting or increasing the merchandise inventory account. Why are we doing this? Because remember, the cost basis for merchandise inventory is what you paid for the merchandise inventory plus any normal and reasonable expenditures to get it ready for sale. Paying for shipping is a normal and reasonable expenditure to get it ready for sale when it's FOB shipping. Okay? So that's why we debit merchandise inventory. All right, so I'm going to end this lecture video now, and then the next lecture video will be some practice problems on accounting for purchasing merchandise inventory. Thank you.